Have you ever looked at your finances and just wondered what the government actually sees? Because it's definitely not just the number on your paycheck. Today, we're going to deconstruct your income, and we're going to use the official legal blueprint to figure out two of the biggest pieces for most people, your job and any rent you might collect. So let's dive in.
So, what really counts as your income when the law looks at it? I think you're going to be surprised. It is so much more than just the cash that lands in your bank account. And the answer is all spelled out for us, so let's take a closer look.
Okay, first things first. The starting point for absolutely all of this is a concept called total income. You really should think of it as the master blueprint for your entire financial picture, at least from a legal perspective. It's the grand total of everything you earn.
But total income isn't just some random jumbled number. No, the law is incredibly specific. It breaks everything down into these neat little categories called heads of income. And this is where it gets really interesting. Each of those categories has its own unique set of rules.
And here they are, the 7 official heads of income. You can see it covers the whole shebang. You've got your salary, any rent you collect, agricultural earnings, business profits, capital gains from selling things like property, income from your investments, and then there's this little catch-all for everything else. For today, we're going to zero in on the two that affect most of us the most, employment and rent.
All right, let's start with the one we all know best, our paycheck. Think of this as the first major building block of your total income. And as you're about to see, it's made up of a whole lot more than just your monthly salary.
And this is a really key point. When the law talks about salary, it means way more than your base pay. It's a super broad term that covers almost everything your employer gives you. I mean, we're talking bonuses, commissions, getting paid for unused vacation days, and even those non-cash benefits we call perks.
You know, what's really fascinating is the contrast here. On one hand, the law is designed to scoop up pretty much any benefit tied to your job, things like stock options or even severance pay. But on the other hand, it has these very, very specific carve-outs, like getting reimbursed for certain medical procedures or for travel expenses you use while you're actually doing your job.
I mean, just listen to this phrase. It really shows you how wide the definition of employment income is. This literally means that a sign-on bonus from a job you haven't even started yet, or maybe a payment you get from an old employer, well, that can still be counted as part of your income for the year. The net is cast incredibly wide.
Okay, so let's dig into those perks for a second. These are those non-cash benefits that, believe it or not, have a real cash value for tax purposes. Why? Well, it's simple. A benefit is a benefit, and the law has a really clear system for figuring out exactly what they're worth.
It really makes you think, right? For example, how much is that company car you're driving actually worth on your tax return? It's not just some nice little bonus, it's a calculated, concrete part of your income. And the law tells us exactly how to do the math.
So check this out. This table lays it out perfectly. If your employer gives you a place to live, the full rental cost gets added to your income. Simple as that. And for a company car, well, there's a fixed monthly value that gets tacked on, and it just depends on the engine size. Pretty much anything else is just valued at whatever its fair market price is.
Let's just pause on this number for a second. If you have a company car with a bigger engine, the law says that's a benefit worth 25,000 taka every single month. I mean, that adds up to a huge amount of money tacked onto your taxable income over the course of a year.
So that's how the law looks at what you get from your job. But what about money you earn from other places, like a property you own? Let's move on to our second building block, income from property. If you're a landlord, listen up, because the law has a very specific blueprint for you too.
At its heart, the basic formula is pretty simple. Your taxable rental income is just your gross rental value minus any expenses you're allowed to claim. But of course, the real story is in the details of what those two things actually mean.
So how do you figure out that gross rental value? Well, the law basically breaks it down into these 4 steps. First, you start with the actual rent you collect. Then, you add in any advance payments that apply to this year, plus any extra charges your tenant is covering. And finally, you get to subtract an allowance if the property was empty for a little while.
Now for the other side of that equation, expenses. The law lets you deduct certain costs from your rental income, and a great way to think about these is as official discounts on your taxable income, because they recognize the very real costs of owning a property.
So what can you actually deduct? Well, the list includes pretty logical things, like property insurance, the interest on your mortgage, and any local property taxes you pay.
But there's one more that's especially interesting, because it just makes life so much easier for every landlord.
You see, instead of making landlords track every single tiny repair and hold on to every last receipt, the law just simplifies the whole thing. It gives you a standard percentage-based deduction to cover all those little ongoing costs. It's a really practical solution to what could be a very messy problem.
And you can see the standard deduction rates right here. For a commercial property, you can lop off 30% of the rental value right off the top. For a residential or non-commercial property, it's 25%. It's just a super straightforward way to account for the costs of being a landlord without all the endless paperwork.
Now here's one last important detail for all the landlords out there. What happens if you take that standard deduction, but you don't actually spend all of it on repairs? Well, that unspent amount can actually be treated as special income from rent. It's just a little something to keep in the back of your mind. Okay, so let's bring it all back together. The real key takeaway here is that your total income isn't just one single number. It's built from all these different blocks. And as we've just seen, each of those blocks, from your salary to your rental checks, comes with its own very specific instruction manual.
So why does any of this matter? It's simple. Understanding this blueprint is power. Knowing what counts, what doesn't, and what you can deduct, that is the absolute first step to really getting a clear picture of your finances and taking control.
So, we've walked through the official rulebook for both employment and rental income. We've seen the blueprint. Now that you know the rules of the game, how does your income stack up?
Let's be honest. When you hear the words income tax law, what's the first thing that comes to mind? Probably some dense, super complicated document, right? Well, what if I told you it's not a maze, but a map? A surprisingly logical system for sorting out every dollar you earn. Today, we're going to unfold that map and figure this thing out.
It's a really good question. I mean, think about it. You might have income from your job, maybe a side hustle, maybe you sold some stock, and it feels like there's a different rule for every single thing. How does the system even handle all of that without just turning into complete chaos? Well, here's the secret. It's not a maze at all. It's a map. The tax code is designed to give every single dollar of income a specific territory where it belongs. So in this explainer, we're going to navigate that map together. We'll start out in the fields of agricultural income, then head to the city of business income, we'll scale the peaks of capital gains, and finally we'll explore those fascinating wildlands known as other sources. All right, our first stop is one of the oldest kinds of income there is, agriculture. But as you're about to see, when the tax code looks at a farm, it sees a whole lot more than just planting and harvesting crops. The first thing you'll probably notice is just how broad this category really is. When the law says agriculture, it doesn't just mean wheat fields. We're talking about everything from poultry and fish farms to growing timber and even producing honey. It's a surprisingly wide umbrella.
And this is where the map gets really specific and kind of cool. If you grow and process tea or rubber, the law actually splits your income right down the middle. Well, not quite the middle. 60% of what you make is treated as agricultural income, but the other 40% gets classified as business income. It's a perfect example of how this map has these little special zones with their own unique rules.
Okay, so selling produce is one thing. But what about the bigger stuff? What happens when a farmer sells a major asset? You know, like a tractor. This is where the map gets a little more detailed, but stick with me. The logic is actually pretty straightforward once you see it.
So here's how it works. The whole key is understanding how the profit gets sliced up. First, you just compare what you sold it for to what you originally paid for it. Now, if you sell it for more than you paid, that extra bit of profit, the part that's above the original price, that's called a capital gain. We'll dig into that more in a minute. The rest of the profit is just plain agricultural income. And what if you make a profit, but you still sold it for less than you originally paid? Simple. It's all considered agricultural income. And of course, to figure out the final amount that's actually taxable, farmers get to deduct all their legitimate expenses. You know, things like rent for the land, interest on farm loans, or fixing machinery. All those costs of doing business can be subtracted from the income.
All right, let's move from the countryside into the city, to our next big territory on the map, business income. And as we explore this area, you're going to see a really familiar pattern start to pop up, which is one of the coolest things about getting how this system works.
Hey, remember that rule about selling a tractor? Well, get this. The tax code uses almost the exact same logic when you sell a business asset. Any profit that's above the original cost gets split between a capital gain and business income. This is a huge aha moment. It shows you a core principle of the map. Once you understand the logic in one territory, you start seeing the same patterns pop up everywhere else.
And just like with agriculture, this business income category is really broad. Yeah, it covers the obvious stuff, like the profits from your main operations. But it also includes things you might not expect, like gains you make from currency exchange or even money that comes in after a business has already shut its doors.
And again, that parallel just keeps going. To figure out their final taxable income, businesses can deduct their legitimate costs, things like raw materials, office rent, advertising, and salaries. The principle is exactly the same, it's just happening in a different territory of our tax map.
So we've tossed around this term capital gain a few times now, in both agriculture and business. So let's zoom in on that specific region of our map for a second and get a really clear definition.
So what exactly is a capital gain? Well, put simply, it is the pure profit you make when you sell an asset for more than you originally paid for it. That's it. It's the difference between the sale price and that original cost.
A really easy way to think about it is like this. Say you own a building. The rent you collect from it every month is one type of income. But the profit you make when you eventually sell that building for more than you bought it for, that's the capital gain. It's a totally separate category for the profit you make just from an asset going up in value.
Okay, we've covered farms and we've covered businesses, but what about, well, everything else? This brings us to the final and maybe the most interesting section of our map, the catch-all categories and the rules that really tie this whole system together.
So this raises a really good question. Where on this map do you put money that doesn't fit neatly into those other boxes? I'm talking about things like a government subsidy or, hey, winnings from a lucky card game. They have to go somewhere, right? You bet they do. They land right here, in income from other sources. This is the map's catch-all territory. And it includes a really fascinating mix of things. Royalties, government subsidies, lottery winnings, even unexplained money that just shows up in your accounts. It's the tax code's way of making sure that every single dollar has a home. And that's really the main takeaway from all of this. The system is designed so that nothing can fall through the cracks. Whether that money comes from a farm, a business, an investment, or a lucky lottery ticket, there is a specific category just waiting for it. Okay, last piece of the puzzle, and it's a super practical question. You know, life isn't always about profits. What happens when one of your ventures loses money, but another one makes money? Can you just mix and match them to cancel each other out? The short answer is, generally, no. See, the map has borders. As you can see here, a loss from a business can only be used to offset a gain from another business. A capital loss can only cancel out a capital gain. These territories are distinct, and you usually can't use a loss from one to just wipe out a gain from a completely different one.
And that really brings us right to the heart of it. All that complexity of the tax code, it really starts to fade away once you see it for what it is, a comprehensive system for classifying money. It's all about putting every dollar in the right box. Once you know what the boxes are, the rules start to make a whole lot more sense.
So we've journeyed through the main territories of the tax map together. And now the question is, really for you. Think about your own financial world for a second. With this map in hand, where does your income fit?